All right, guys, welcome back to this channel. As always, my name is Albert. Welcome to Kingdom Finance Hub. Now, in this video, I'm going to break down 10 mistakes that destroy beginner traders. And I'm not speaking from theory, I'm speaking from experience. Most beginners don't fail because they are lazy or not intelligent. Now, they fail because they repeat the same mistakes, entering too early, trading emotionally, chasing the market, switching strategies, over risking, and trading at the wrong times. Now, if you avoid these 10 mistakes, you won't automatically become profitable overnight, but you will do something even more important. That is, you will stop leaking money and start building the discipline and structure that traders require. Now, without wasting your time, let's go straight into the video. Now, these are the mistakes that I committed several times when I started trading. Now, this cost me a lot of money, blowing a lot of accounts, failing a lot of profits accounts until I mastered how to overcome these strategies. Now, believe me, it doesn't matter whether you're a beginner or you are intermediate or even well experienced trader. But if you are able to master these mistakes and know how to overcome them, now this will not only help you to become profitable, it will also build your confidence in the market. Okay, because one of the things that really brings us down is, for example, if you want to take a trade and you are not too confident, you've done all your analysis, all your confluences are checked, but still you are not confident whether this trade will go in your direction or not. Okay, so when you're able to overcome these mistakes, it will build your confidence, and it also help you to master discipline in the market. Okay, because trading, one of the key qualities of a good trader, a profitable trader, is discipline. So it helps you build discipline as well. So let's look at these 10 mistakes. Now let's move on to the first mistake. So mistake number one. Now, not waiting for candle stick closure. Oh my days. Now, this is very important. Okay, this is so important. Now, when a candle is still forming, it can look like a breakout or a reversal or a strong momentum, but until it closes, that move is not confirmed. Now, take note of that. Now, when I started, many a time I'll enter at mid of a candle because of the fear of missing the move. And what usually happens is so simple: the candle closes differently than what it looked. Okay, so simply put, I got trapped all the time. Now, a wick is the market showing you rejection. A close is the market confirming direction. So if your strategy involves breakout, now you must base your decision on a candle that closes beyond that level, not one that just touches that level. Now, if your strategy involves just reversal, now you must wait for the candle to close and show rejection, not just a temporary spike. So, for instance, let's say you are trading, yeah, you have a massive move here, okay, and there's a little pullback, right? Now, you want to enter at this level, okay, you want to enter at this level right here, okay, you want to enter at this level. Now, you see a massive candle. In other words, you want to enter a buy, okay, you want to enter a buy at this level or price right here. Now, you see a massive candle. Let's say the price open right there, and you see a massive candle, okay, a massive candle which pull from here to here. Let's say you are on a 5 minutes, or let's say even 15 minutes uh chart. Okay, so let's say we are in, the candlestick is in for, let's say, 11 minutes. Okay, and for that 11 minutes, there's a massive bullish candle that is forming to the top. Now, mostly what happens is that, or the mistake that beginners do, which I did several times, I can't recall the number of times I did, but that was a lot. Now, when I see this candle, I immediately enter at this point. Okay, I enter because of the fear of missing this move. So the market opened here, but you saw this massive move to the upside. Okay, now The candle is just 11 minutes. Okay, we are left with 4 minutes for the candle to what? Close. Now, what we need to do is to wait. Okay, always wait for candle closer, because many a times what do happen is that when there's this massive move to the upside like that, what happens is that the candle stick can move all the way down and leave a wick like this. It can move all the way down and leave a wick like this, and sometimes even close below the level at which you want to buy, which obviously does not take your confluence of entering a buy. Okay, but take note, the market moved massively to the top and it did to the down at candlestick closure. That's why you are always advised to enter at candlestick closure. Okay, this is so important. So it doesn't matter the time frame you are on, whether you're on the 5 minutes, whether you're on the 1 minute. Okay, now, and you see a massive move to the direction that you're looking forward to take the trade, wait for the candle to close, because most of the time the candle will close and will not take that confluence you are looking for to enter the trade. Okay, so that is mistake number one that we need to avoid. Now, number two, what is the second mistake that we need to avoid? That is revenge trading. Okay, revenge trading. Now, this is very serious, and you know, this is the reason why many beginners also, you know, give up on trading. Okay. Now, what is revenge trading? Revenge trading is where you lose a trade. Let's say you lose £100 or $100, okay, on a trade that you took, and you want to take another trade. Okay, you want to take another trade, but this time around you want to recoup this money from this trade. Okay, many a time what happens in the revenge trading is that in the second trade we tend to take a higher lot size, either double of what we did. So for instance, let's say our lot size here was 0.05. Now in the revenge trading or the second trade, you want to trade 0.2 or something, even what, even higher. Okay, now what happened is that, believe you me, 80 out of 100%, okay, 80 out of 100, you are not going to what, you are not going to win this trade. Okay, now that emotional agency changes everything, because you start entering trades you would normally ignore. Okay, so you take trade that in normal circumstance you wouldn't have what, you didn't have taken, because you are rushing into the market because you want to quickly recoup or get back the money that you've lost. Okay, so this is one of the easiest way to blow your account. This is one of the easiest way to blow your account. I hope that is clear. So your job here as a trader is not to get the money back. Okay, it's not to get the money back. Okay, it's not to get the money back, but what is your job? Now your job here is to have an execution plan. Okay, execution what, plan. So for instance, let's say for each day, you're looking forward to take maximum of 3 trades. Okay, and each day, let's say on each day or each trade, you're looking forward to risk $100. Okay, so that means for a day you're looking forward to what, to risk $300. Okay, so after you've taken one trade and it's a loss, after you've taken trade two, it's a loss, after you've taken trade three and it's a loss, brother, sister, my friend, just leave trading for that day, because your plan is to enter 3 maximum trade. So it doesn't matter if you've lost all the three. Close your laptop, close your phone, shut your phone down, and wait for another day, because this is your plan and you need to stick to your plan. However, when you lose and you try to get your money back, believe me, chances are that you are going to what, lose more money. Okay, so the second point is revenge trading. Now let's move on to the third mistakes that we need to avoid. Okay, now this is very controversial and of course is subjective, but I'm going to explain myself. Now, paying for signals, okay, paying for signals, and let's say chasing communities. Okay, paying for signals and chasing communities. Now I'm going to explain. I've lost a lot of money in the past. for joining some communities or some telegram group or channel. Now, what happened is that now when I joined, okay, I was asked to deposit $1,000, okay, which I did. Now they sent a signal, a trade signal, okay, and I entered the trade. Okay. Now, in just one trade, my $1,000 account grew from 1,000 to 6,000. I think for something. Let's say 6,000. Okay, in just one trade, because they tell you what to do, and based on your account size, the lot to take. But one thing I realized was that I was not able to withdraw. I was not able to withdraw this money. Okay. And believe me, they have some dicey way to, you know, give you all sort of excuses and all sort of, I don't know, that you are unable to withdraw this amount of money. Okay. Now what they do is that they want you to even deposit more. Okay, deposit more money. Okay, they tell you, okay, even though you are in a VIP group, there's another something VVIP group that you can join, something like that, like always trying to take you a step further. Okay, and taking you a step further means paying more money. Okay, now what I realized after some weeks ago is that these guys, okay, have an account. Okay, they have an account. Remember, some of them, when you create an account, they will give you some code and also whatever it is. Now what happens is that you are adding to their what, to their portfolio. Okay, you are adding to their portfolio. Now if you win, they win. If you lose, they lose. Is that clear? If you win, they win. If you lose, they lose. Is that clear? So let me be direct. Now, many signal groups are designed to sell you hope, not build your skills. Now, some of them just hook you with strong early results. For example, like I've said, I've been in situations where I deposited money. Now, the first signal again was a very big win. Okay. Of course, it made me feel like, okay, well, look, I found something special. But later, the patterns became clear. The wins are used as just marketing losses were hidden, ignored, and also, I mean, they explain things away. And when you take things further, if things go wrong, now they tend to even blame you. Okay, they tend to even blame you. Now, many groups also depend on risky method that, uh, you know, it wins often, but collapse with volatile or volatility what changes. Okay, so mind you, lot of these groups are scam. Okay, not all of them. Okay, a lot of these groups are scam. I have a friend of mine that also joined the group. They were asked to deposit money, and some people even went to the extent of selling their assets. Okay, so that they'll use the money to join. And after a few weeks, they'll promise you, look, you can withdraw the money maybe after 6 weeks, after 3 months. Now, when the time is up and you are going to withdraw, they give you loads of excuses. Okay, they give you loads of excuses. Now I have so many friends that that have shared all these things. Now, so believe me, it is advisable. Okay, if it is advisable that you look at long term. Now it is part this is part of the reasons why I decided to learn things myself. Okay, so I learned things independently. Okay, yeah, I read books, YouTube channels, I took you know YouTube channel, and any relevant information that I came across. Is that okay? Any relevant information that I came across. So, guys, mind you, not every group is in to help you. Every group is in for their own interest. Okay, every group is in for their own interest. So make sure you find a good one, especially ones with very good reviews that you can follow. Otherwise, believe me, you will end up losing your money. And Listen, you can't even, I mean, it's a group. You are just chatting with someone that you don't know. You don't know the person physically. You don't know the person's details, the person where about. You just see in a group the person's name whatsoever. Most of these people are having, a false identification. Okay, they may be called A, in reality, but they've put there that they are B and all those kind of stuff. So watch out so that you don't lose money to these guys. Okay, now mistake number 4. Okay, now changing strategies. Okay, so you change your strategies anytime you lose. Okay, so you change strategy anytime you lose a trade. Now this is not advisable. Okay, this is actually not advisable. Now every strategy has a losing streak. Okay, mind you, no strategy is 100%. Now even professional systems go through drawdowns. Okay, so you need to understand that. Now beginners often confuse themselves with normal drawdown and a broken strategy. So they change from one strategy to the other. Okay, so today they come to the trading platform. Okay, they take a trade, they lose, they begin to doubt their strategy. Okay, well, I lost, so my strategy isn't good. So they begin to date for different strategies. Okay, so most beginner traders have over 100 strategies. Why? Because each strategy they lose, okay, is not a good sign. What happens is that they are, looking forward to switch to a different strategy, hoping that that strategy will help. But can I tell you the truth? The truth is you cannot evaluate a strategy based on 5 trades or 10 trades. You need real sample size. Okay, so you need to test the strategy for at least 3 months. Okay, 90 days. Okay, at least 90 days, or let me say even 50 trades, ideally 100 trades if you can. Okay, so don't just change. So for example, let's say you trade in breakout. Okay, let's say you trading your strategy is breakout. So for instance, let's say there's a ranging market here. Okay, there's a ranging market here, and you look forward to trade when there's a breakout from this consolidation. Okay, so some people will trade when there's a break. In other words, they'll buy when there's a break to the upside, and they sell when there's a break to the downside. Okay, some people will also, after they break to the upside, they wait for a pullback, then will sell. The same thing applies here. They wait for a pullback, then they sell. Okay, this may be your strategy. Some people also trade the ICT zone. In fact, I have a video that you can look out, you can check. The ICT breakout is very good for trading gold. Okay, it's very good for trading gold. Last week and last 2 weeks, I used this strategy to get a lot of money from the market. So you can check my video in the description. Okay, so no matter your strategy, so if you have a strategy and you fail, okay, do not change the strategy. However, you need to ask yourself what went wrong. Okay, what went wrong? Okay, maybe you entered at the wrong time. Maybe your analysis was not, complete. Whatever you needed to, take into consideration, you did not take all and all that. Okay, so commit to one strategy, guys. Commit to one strategy. Okay, and if you want to improve a strategy, change just one variable at a time. Okay, if you change everything at a time, you will never know what exactly helped. Is that clear? You never know exactly what. So for example, again, using the breakout strategy. Okay, using the breakout strategy, for example, let's say you only take trade on the 5 minutes time frame. Okay, now if that didn't work, let's say you took a trade and it failed. Now why don't you try 1 minute or 15 minutes? Okay, now you just change a variable from that strategy. You don't take everything. Another example, if let's say you trading let's say you trading the open range. Okay, open range break the up. Okay, the open range, but in other words, for example, if you trading the landing session, okay, on a 15 minutes or on the 1 hour, you look for let's say for the 15 minutes time frame, you look for the first candlestick at the landing open. Okay, so this is 15 minutes. You wait for the first candlestick at the landing open. So if this candlestick is, let's say, bullish, okay, now after this candlestick open, you're waiting for a break of the open range. Okay, you're waiting for a break for the open range, that is this side. If a candle closes above here, then you're looking for a buy. Okay, some people enter straight, some people also wait for the price to the 50% level, okay, or point of the open range before they what they take their trade. No matter your strategy or whatever it is, then yeah, you just change a variable rather than switching a whole strategy, because no strategy is 100%. Okay, now let's move on to mistake number 5 that we need to avoid. Now mistake number 5 is following everyone on YouTube. Yeah, so you want to follow everyone on what? On YouTube. Okay, guys, believe me, there are a lot of channels, there are a lot of traders out there on YouTube, and everybody has different strategies, different plans. They have different ways by which they analyze and see the market, and believe me, some of them are good, others are not. I mean, you find this everywhere. But my advice to beginners is that, look, just find one or two, maximum three, okay, three mentors from YouTube. Now when I say mentor, it doesn't necessarily mean you need to get into contact with the person directly. No, when I say mentor, I mean find some people that you know you can learn from them. Is that okay? Some people that you can learn from them. So I have three people that I follow. Okay, I have three people that I follow. So one or more educators maximum, and follow them for a fixed period, like a month or two, and see if their content is something that you love. Okay, see if their content is something that you love. Is that clear? Now let's move on to mistake number 6. Now, as a beginner, don't start with too much capital. Okay. Now, by experience, I've realized, or I found out that I'm more successful when I trade with small account. Okay, when I trade with small account. So for instance, when I trade with $200, like between 100 and $500, I find more success. Okay, so for instance, I can grow $200 account to, let's say, $2,000. Okay, however, if I've seen on several occasions where if I have $1,000, I blow this account within 2 weeks. Okay, sometimes even within a week. Now the reason is very simple. Now if you have a large capital, let's say from $1,000 to, I don't know, maybe 10,000. Okay, now you tend to trade bigger lots. Okay, you tend to trade bigger lots, and when the trade goes against you, you lose big. Okay, you lose big. However, if you are with a small money, the account is small, you need to stick to small lot size. So for instance, if you trade in gold, okay, you don't trade more than 0.03. No. Is that clear? So you realize that with even this small lot on the small account, you are able to have higher win rate. Okay, and at the end of the day, you are able to increase your account to this. By the way, this is my personal experience. You're able to increase the account. Sometimes you're able to double the account within just one, two, three trades, or even within a week. I can't recall the number of times that I've transformed $300 account, like doubled it, sometimes tripled within just a week. Yeah. So yeah. So if you're a beginner, I would advise stick to small account between 100 and 500 dollar account. All right. Let's move on to number 7. Now, what do we have to do as a beginner? Now, impatience and forcing trades daily. Okay, you don't have, or let me say, need or even must trade every day. No, guys, you don't need to trade every day. It's not compulsory, it's not by force. Okay, so again, this goes with the saying patience. Okay, like you feel like, look, every single day you need to trade. There have been days where I've sat behind my laptop just looking at charts, analyzing, and I don't see any confluence within the market, so I don't trade. There have been weeks where my setup is not, giving me any signal of trade. Now, look, be patient, wait. Don't chase the market, wait for the market to come to you. So trading is not a job where you get paid for activity. Okay, so it is a job where you get paid for correct decision worth making. So if your setup is not there, then your trade is not there. So over trading increases, of course, you losing because you start trading low quality condition, choppy market, unclear structure, random moves. Okay, so here's what you need to do. You need to create a clear rules on what a top setup looks like. Okay, and always wait to make sure that you've ticked all the boxes. Okay, you've ticked all the boxes before you enter a trade. Okay, so for example, if you're looking for, I don't know, maybe three confluence before you take a trade, wait for all the three to take. So even if you have two and you are left with one, okay, don't enter. Okay, don't enter. Wait. Okay, disciplined traders sit sometimes for hours, okay, sometimes for days to get a clean setup. But guys, it's not about the quantity of trade. Okay, it's not about the quantity of trade, it's about the quality of what? The quality of trade. So don't go into the market every day. Okay, I wake up in the morning, today I need to trade, the next morning I need to trade, the next morning I need to trade. No, guys, you don't need to trade. You don't need to trade. Make sure you only trade when your setup is what? Is ticked. Now let's look at the eighth one. Okay, now this is very important. Now when you trade in low liquidity period or time, okay, very important. Now when there's low liquidity, okay, when there's low liquidity, okay, now what happens is that price movement is not clean. Okay, so we don't have a clean price what? We don't have a clean price movement, and the spread is very wide. And you see that the moves are very choppy. Okay, very choppy move. Okay, choppy what? Choppy move. Okay, very slow as well. And you know, now when that happens, the price becomes unpredictable. Okay, the price becomes unpredictable, so you need to take note of this. Okay, so beginners often trade at random times without understanding the sessions. Okay, so the three key sessions: we have the Asia, we have the London, and we have the New York. So they take trades when the market is low, then they wonder why price behaves unpredictably. So you should define the trading window. So some people trade only at the London session. Some people trade at the New York session. Most people try to avoid the Asia session. That doesn't mean you can't trade in the Asian session. I've had some success during several success during the Asian session. Okay, yeah. But now I tend to only trade during the New York session. Okay, I tend to only trade during the New York session. But it doesn't matter. Some people trade during the London, during the New York, and that. But of course, based on your trading plan, based on your structure, based on your system, you need to find the session that works best for your strategy. And of course, you get in there. Now let's quickly move on to point number 9. Now, this point is very, very important. The poor risk management. Okay, poor risk management. Now, many beginners focus on entries only, but the entries, believe me, do not matter if your risk is wrong. Now, if you reach too much per trade, you blow up your account. Okay, even if you are right. Okay, and if you don't use stop loss properly, just one trade can what wipe all your trade. I remember when I started, I'll take a trade. Okay, and I said no stop loss and no take what take profit. Okay, yeah. So sometimes, let's say if my account is $500 and I take a trade, let's say going to the upside and the market begins to move against me. Now you realize that I'll be in a loss, let's say minus let's say 100. I say okay, let me leave it. Will go up. By the time I check again, maybe minus 200. Okay, well, let me leave it. By the time I check again, maybe minus 250. Now, if you realize your account, over 60% of your account is what is gone. Okay, so guys, always make sure you set a stop loss and a take profit. Always, always. And know the amount you want to risk per trade. Is it 1%? Is it 0.5%? Is it 2%? Know what you want to risk per trade. Okay, and stop moving your stop loss. Okay, so for instance, you've taken a trade somewhere here. Okay, and your stop loss is somewhere there. Now if price come to your stop loss, now what happened again, and I've done this several times, if what happens is that we tend to move the stop loss from this point below here. Okay, so this was our stop loss, but this is our new what? This is our new stop loss. And even sometimes the market comes further, and we tend to move our stop loss even what even further down. Okay, so guys, these are some of the things that we need to avoid. Now, if you set a stop loss and your stop loss is hit, don't worry, it's part of the game. Okay, no, even professional traders lose sometimes. Okay, so it's part of the game. You are not the first person to have all wins throughout the month or throughout the year. No. Okay. And you don't want to break that record. By all means, you are going to what? You are going to have some losses. Okay. So guys, make sure your risk management is top notch. Okay. Because like always, it's not about the the trade, the trade that you take. It's how many trades. Okay, how many trades can you take with your account? How many trades? So, for example, if you have a $500 account, do you want to take one trade with this account, or you want to take 10 trades with this account? Okay, so if you want to take 10 trades with this account, now simply you are risking $50 per trade. Okay, you're risking just $50 per trade. If you want to take just 5 trades per this account, that means you're risking $100 per trade. Okay, yeah. So some people also want to take just one trade, so they risk everything. They risk all the $500 maybe for $2,000 or whatever. So if it goes against you, then you just take one trade. Yeah, so the question is, how many trades can you take with your account? You want to just take one trade, 5 trades, 10 trade. Now decide upon that. Now you know the risk percentage that you have to take, then you move with that. Always make sure you don't move your stop loss. Okay, so trading is a game of survival. So survival first. If you protect your capital, you stay in the game. If you don't protect your capital, now you quit the game. Right. Okay, now let's move on to the very last point. Okay, what is the last mistake that we need to avoid? Not having a trading plan, and also keeping journals of your trade. Okay. Yeah, so if you don't write the rules down, your strategy becomes flexible, and flexibility usually means emotional. Okay, so make sure you write your rules down. Okay, so for instance, you say, I don't trade. Okay, I don't trade if okay, I don't trade if the market is not in the New York session. Okay, okay, you can say I don't trade if, let's say you have three confluences. You say I don't trade if all these three are not what tick. Is that clear? You can say I don't trade on, let's say, Friday. Okay, you can say that. So now when you have these rules down, for example, let's say you say you don't want to trade on Friday, and on Friday you pick out your laptop or your phone and you see a very good setup, which you are really, really confident that, look, this setup is going to give you money. Now what will happen is that, look, because these are rules for you, no matter how great this setup or this opportunity that you've located, you don't trade. Okay, so have your rules written down and be honest with yourself. You make sure you follow the rule. Okay, you follow your rules. So, very important. And another thing is that you make sure you take notes, make sure you journal your trade. Okay, so every week, all the trades that you took, make sure you journal them. So you took, let's say, this trade. Okay, why you took this trade, okay, why you took this trade. Now make sure you write them down. Now what this is going to do is that it helps you take responsibility of your action. Okay, okay, so for instance, let's say you took a trade and the trade was $200 loss. Okay, you ask yourself why. So maybe you entered based on this condition. You go back to your chart. Okay, you draw your analysis and you learn from the mistakes that you committed. Maybe this condition was not strong enough. Okay, maybe that condition was not strong. Maybe you should have waited for, let's say, 5 minutes more. Maybe you should have waited for this. Maybe you shouldn't have even entered uh, at all. Maybe you should have entered early and all that. So this helps you to take responsibility of your decisions on a trade. Okay, so it is very important that you plan all this. You plan what market you trade. Okay, so the market that you trade, you plan the time frame that you trade, you plan also the window in which you trade. You now this have your setup always up and ready, your entry conditions, have them ready. You also need to know what invalidates your trade and all that, the risk per trade. Now, listen, you need to have all this, okay, and also the maximum loss per day, okay. You need to have all these in place, okay. And as like I said, you need to also take journal for this, okay. If you have to screenshot all these, make sure you do that. Is that clear? Right, so these are the 10 mistakes that beginner traders can avoid. So not waiting for candle close, also revenge trading, paying for signals and chasing growth, switching strategies after losses, following too many opinions, starting with too much money. Okay, starting with too much money, also impatience and over trading, trading in low liquidity times, poor risk management, no plan or no journal. Now, if you want to improve fast, don't try to fix everything today, guys. Pick just one or two, okay, of these mistakes, okay, if you can relate, and correct them every week, okay. Make sure you master it, because if you want, if you also want, just comment the word plan and I'll share a simple one page trading plan structure that you can copy. Is that clear? And if this video helped you, please subscribe, because I'll be uploading structured beginner lessons that will focus on real trading discipline, not just hype. Okay, so thank you very much for watching this video. As always, this is for educational purposes and not a financial advice. Thank you very much and see you in our next video.